Something extraordinary just happened in the silver market. In less than a single trading week, silver delivered one of the fastest price accelerations seen in years. What looked like another quiet downturn suddenly flipped into a vertical rally that caught traders, analysts, and even institutional desks off guard. Most headlines are blaming inflation fears. Others are pointing at currency weakness. Some are saying China. Some are saying industrial demand. But none of those explanations answer the real question. Why did this move happen with such speed, at this exact moment, and with this level of force? Because what just occurred was not a normal rally. It was a structural market event that very few people recognize while it's happening, and even fewer understand how to measure while it's still unfolding. And according to veteran precious metals analyst Alastair MacLeod, the mechanics that caused this eruption are still active right now, which means this story may be far from over. Tonight, we break down the hidden market structure behind the surge, the positioning data almost nobody is watching, the physical demand forces that make this move different, and the exact signals that tell us whether this is just the first phase of something much larger. This is not hype. This is market mechanics. Welcome to the report. Financial commentary tends to explain price moves using macro headlines. Inflation, central banks, geopolitics, currency weakness. Those factors absolutely matter over long time frames. But they do not explain why a metal can jump violently in just 4 sessions after weeks of weakness. Price velocity like this only happens when the structure of the market itself breaks. And when that happens, the move is driven not by eager buyers but by trapped sellers. Imagine a market where the majority of traders have positioned for prices to fall. They've shorted futures contracts. They've borrowed and sold. They are convinced the trend is down. Now imagine the market stops falling. Then it begins rising. Suddenly, those traders are not in control anymore. They're losing money. Their brokers demand additional capital. To stop the losses, they must buy back what they sold. That buying pushes the price higher, which forces the next group of sellers to buy back, which pushes the price higher again. This feedback loop is not driven by optimism. It's driven by financial survival. And this phenomenon is known in professional trading circles as a bear squeeze. It is rare. It is violent. And it produces price action that feels disconnected from the news. Because it is. This is where the story becomes measurable. On the Chicago Mercantile Exchange silver futures market, something unusual has happened over the past weeks. A dramatic collapse in open interest, the total number of active futures contracts. Open interest tells us how crowded a trade is. High numbers mean lots of participants. Low numbers mean most traders have exited. Recently, silver's open interest fell to levels not seen in over a decade. That means the speculative crowd that was betting on lower prices had already largely left the market. So when prices unexpectedly turned higher, there weren't many sellers left. Only trapped ones. And that's the precise condition required for a squeeze to ignite. Here is the mathematical fingerprint. In a healthy rally, prices rise and open interest rises. New buyers enter the market. In a squeeze rally, prices rise, trading volume explodes, but open interest does not rise. Because the activity is not new buyers entering. It's old sellers exiting. That exact divergence just appeared in silver. Heavy trading sessions. Flat or declining open interest. This is textbook squeeze behavior seen in commodities, equities, and currencies during historic reversals. This is where the story escalates. Silver is not alone. Gold futures on the same exchange are displaying nearly identical positioning patterns. A major reduction in active contracts, yet prices holding firm instead of collapsing. When two closely linked monetary metals show squeeze conditions simultaneously, historical precedent suggests this is not a short spike. It often precedes multi-month directional moves. Most short squeezes end quickly. Prices spike, sellers cover, and the rally fades because there's no real demand underneath. But silver is not just a financial asset. It is a critical industrial input, and global demand for it is accelerating at the exact moment the squeeze is occurring. Solar panel production now consumes extraordinary amounts of silver annually. Electric vehicles require it for conductivity. Electronics, military systems, medical equipment all depend on it. This is not optional demand. It's structural. Even if investors disappeared, industry alone would still be pulling millions of ounces from the market each month. That creates a demand floor that did not exist in previous decades. India is historically one of the world's largest physical silver buyers. Recent administrative delays have slowed imports, creating a backlog of unmet demand. When these channels reopen, buying does not resume gradually, it arrives in waves. That wave can collide with already tight supply. China, a major processor of silver, has been reducing exports and prioritizing domestic supply. When a key supplier stops feeding the global market, available liquidity tightens rapidly, especially during rising industrial usage. The U.S. government recently added silver to its list of critical minerals. That classification is not symbolic. It signals long-term strategic importance for technology and defense. Strategic materials tend to be accumulated, not freely distributed. Now layer in the macro backdrop. Energy shipping disruptions are lifting fuel prices. Higher energy costs feed inflation. Persistent inflation restricts central banks from easing policy. That traps currencies under pressure. Historically, this combination, inflation plus currency stress, drives capital into hard assets. Silver thrives in this environment. During these phases, silver often outperforms gold in percentage terms, because it is both a monetary metal and an industrial one. It benefits from safe haven flows and manufacturing demand simultaneously. There are 4 indicators that tell us whether this move continues. Open interest levels staying depressed, high daily trading volume without OI expansion, silver outperforming gold consistently, Shanghai versus New York price premiums widening. Signaling physical draw. These are real-time signals professionals monitor during squeezes. Right now, evidence suggests this is stage 1, the forced buying phase. The transition to a full bull market happens when new buyers replace exiting sellers. That is what to watch for next. Those who bought during the panic captured the first move. Those waiting for confirmation are now watching a breakout. The key question becomes, chase strength or wait for consolidation? The data suggests this event is not yet resolved. This was not a random rally. It was a structural shift inside the market, triggered by extreme positioning, amplified by real-world demand, and supported by macro conditions that are still developing. The mechanics that caused the surge have not disappeared. They are still in motion. And that's why this story matters. Because sometimes markets don't move because of headlines. They move because the underlying structure reaches a breaking point. And silver may have just reached one. Stay alert.